everyone, welcome back to my channel. If you are new here, igama lam nguYolanda, and this is Property Talk with Yours, where we talk all things property and equip you guys to make the best property investment decisions. As our fave Maya Angelou always says, when you know better, you do better. And this channel is all about making sure that you guys know better. So let's say last week you watched my video where I talked about the top 5 reasons why you should invest in property today. If you haven't watched that video yet, I will link it down in the description box below, so please make sure you do watch it. But let's say you did watch the video and you decided, you know what, I think this might be a journey that I want to embark on. I want to invest in property, but I really just don't know where to start. And remember guys, this could be a property that you might want to live in, or it could be an investment property. And if you're young and you're buying a property to live in, reality is that you're not going to live there forever, right? You're going to have a family, you're going to move out, get a bigger place. Maybe you want to rent that property out. So you always have to think investment mode and make the best decision for yourself in the future. So I'm sure the next question is, what are the steps, or what should I consider on this journey of purchasing property? And lucky for you, I'm here to help, and I will break everything down for you. I might not mention every single step as people's journeys are different, but what I want to do is highlight the most important things to consider when purchasing property, whether it's a property that you're going to live in or an investment property that you plan to rent out. Today, we'll talk about the importance of a credit score, doing an affordability assessment. This one is very important, guys. Being able to crunch the numbers on your property to make sure it actually makes financial sense and you are making money. Things to consider before you sign an offer to purchase, approaching the bank for funding, and making use of the services of a bond originator. And remember, in everything that I mentioned today, just remember one thing, and that is everything is negotiable. Everything is negotiable, and never ever accept the first offer. Okay, let's get into it. Let's start with a credit score. A credit score is so important, guys, because this is what the banks use to decide if this person is, one, eligible for a home loan. So can we borrow this person money, and do we trust that they will actually pay it back? And two, to determine what interest rate to give you. So in a nutshell, a good credit score tells the bank that you are low risk and you are able to pay back your debt. Therefore, they are likely to give you a low interest rate. Whereas a bad credit score tells a bank that you are a high risk client. Therefore, they are most likely to give you a high interest rate. And remember, we always want to make sure that our interest rates are low as possible. So you need to make sure that your credit score is in the green, and you can use platforms like ClearScore or TransUnion. I will link them down in the description box below, but you can register online and you can use these platforms to sort of check and track your credit score. I will be doing a separate video where I talk about how a credit score is calculated and ways to improve your credit score. But I think the key takeout for today is make sure your credit score is in the green before you even consider purchasing any property. So the second thing to assess is your affordability, and this one is very important, guys. Actually, everything I mention is important, but with this one, I find that a lot of people fall into the trap of purchasing a property that they can't comfortably afford, and the key word here is comfortably, right? So the bank, for example, will say, cool, y'all, you qualify for R1 million. But if you take that R1 million and you calculate the monthly repayments for your bond, plus all the other costs that come with owning or managing a property, then you realize, oopsie, maybe I can't really afford this. Essentially, there's 2 parts to affordability, right? The first one is approaching the bank just to find out how much you qualify for, as this will give you a good indication of the price range of the houses that you should be looking for. This is normally a function of your gross income and all the other expenses or debt that you have. So obviously, the more money you make and the less debt you have, the more money the bank is willing to give you. The second part to affordability is then looking at all the other costs and expenses that come with owning a property, right? So this could be your rates and taxes, your levies, insurance on the property, maintenance on the property, and also just having a reserve fund in case maybe your tenant doesn't pay rent, or maybe you lose your job. Once all the costs are added together, make sure you are comfortable. I can afford this property means I can pay off my bond repayment plus all the other costs I mentioned, my rates, my taxes, my levies, insurance, so forth. So you've checked your credit score, you are in the green zone, it's looking good. You've also done a rough estimate of affordability and you know how much you're willing to part with a month. What now? I think this is the part where we start looking at specific properties, and I think you can also start involving an estate agent to help, but also it's very, very important to start doing some research of your own. You can do research online on property that you want to buy using platforms like Property 24 or Private Property, but I think the most important factor to consider is location, guys. Location, location, location. You should know your chosen location better than the estate agent, which means you need to do a lot of research on the area that you are going to choose. You really want to stay away from areas with antisocial behavior or decreasing property values. The last thing you want to do, guys, is buy in an area that is going downhill, there is little or no development, and people are leaving that area. You really have to do your homework and look for an upcoming location that is being developed, where people are flocking to. And just like some of the things you should look out for is access to transportation, malls and restaurants nearby, schools close by. Just some important factors to consider when looking at a specific area. What you can also do actually is make use of TPN Credit Bureau reports, which are available on their website. Unfortunately, they're not free. You gotta pay either a monthly or yearly subscription, but they have such crucial information and they can tell you certain trends, like are people in a certain area paying their rent, or are they defaulting, which obviously is not a good thing if this is an investment property. There's actually a specific report called the Yield Report, and it gives you invaluable insight into the performance of the rental market in various districts, municipalities, cities and suburbs of South Africa. Once you've done all that research and you've identified certain areas and the properties that you like in that area within the price range, you'll then need to go for viewings. I think the more properties you view, the better. And never, don't do it. Never, ever agree to buy a property that you haven't seen with your own two eyes, unless you are a seasoned investor and you have experience, but I would still not recommend you to do that. Sometimes what you see online and what you see in real life are two different things. So it's very important to view as many properties as possible within a certain area just to get an understanding of the area itself. Once you have identified or shortlisted a few properties, it's important to be able to run the numbers to see if this is the right investment to make. And there are mainly two things we want to calculate off the bat. The first one is rental yield and the second one is cash flow on the property. So in my previous video, I did talk briefly about the importance of cash flow and earning a passive income. And guys, you really need to understand the numbers. You really have to crunch the numbers. Literally do this, just open up a spreadsheet and just do the work yourself. So rental yield is a great way to tell if a property in a specific area might make sense. And basically what it does, it gives you an idea of the rental income relative to its purchase price, right? So to calculate the rental yield, you need to divide the annual, so not the monthly, but the annual gross rental income by the purchase price of the property, and then multiply by 100 to get the percentage. So let's say I purchased an investment property for 800k and the monthly rent is 8,000 Rand a month, right? So you would take 8,000 Rand, multiply that by 12, because remember it's the annual gross rental income, which would then give you 96,000 Rand, and divide that by the purchase price of 800k. So 96,000 divided by 800k would give you 0.12, which is 12%. And this rental yield must always be looked at in conjunction to the prime lending rate in the country. And I think currently it's about 7%. So anything above 7% gives you quite a good indication that this property is likely to be cash flow positive. In order to calculate the cash flow, you will need proof of income and expenses on the property, right? So you need to have an idea of the rental income you are likely to receive and all the expenses you will pay on the property. Now, an estate agent can help in giving you an idea of the income and the expenses that you can expect in the area, but please do the due diligence and just fact check everything yourself, right? So for example, the cost of rates and taxes in the area, that information you can get through an estate agent, what the levies will be if this is in a estate or complex, insurance costs. You can get just a quote on insuring that property. However, if you are staying in a complex or estate, then you don't have to take out insurance on its own. The insurance will be included in the levies that you pay in the estate. So then once you are clear on the income, once you are clear on the expenses, also guys, just make sure you factor an amount for maintenance of the property if this is required. And also in cases where maybe your property is vacant, you don't have any tenants, or maybe your tenant does not pay rent for that month, make sure you factor that into your calculations as well. So once you have an understanding of your income and your expenses, you're then able to calculate the cash flow and you're able to know, is this property a positive cash flow property? So you did your viewings and you did the numbers and you are guaranteed to have a positive cash flow property. At this point, guys, I'm sure you're probably excited, your heart is racing because you have found the perfect property and pretty much ready to do the deal. And this is the part where you want to put in an offer to purchase. But not all of us are lawyers, unfortunately, and sometimes it's very hard to understand complex agreements, right? And here you really need the help of an estate agent. So what is an OTP, or offer to purchase? This is a legal agreement between the seller and yourself as the buyer, and it's so important to be able to understand what is included in this agreement and what are the various clauses that you need to look at before you sign it. I would advise you guys to just take a bit of time, ask a lot of questions. You can always reach out to your estate agent for advice, as this is probably the biggest step you are going to make in this process, okay? Signing the OTP is the biggest step, as this is the binding glue between the buyer and yourself. But there are a few things that you probably need to look out for. Make sure that everything that you saw in that property or house when you went to go view it is part of the deal, right? Sometimes with new estates, they have fully furnished show houses. So make sure you are clear in terms of what you are getting and what the house comes with. So things like appliances and finishes, etc., right? You want to be clear on what stays and what goes. So make sure all of this is included in the OTP. In terms of the price, you want to give yourself a chance to be able to negotiate on the price of the property and make sure you are getting the best deal possible. So something else to look out for in an OTP is something called a suspensive condition or clause. And basically what it means is that if this condition or clause isn't met, then the sale doesn't go through, right? So there's usually a number of suspensive conditions in an OTP. Maybe an example would be you need to have funding, or you need to get a bond within 30 days of signing the OTP. And it's good to look out for stuff like that. So now you have signed your OTP, and unless you have the cash mullah, it's time to approach the bank. And I did mention, guys, in my previous video that banks are more than willing to finance the purchase of a property, but they will still want to get the best deal for themselves. So it's important that you negotiate everything and get the best deal for yourself. As I previously mentioned, everything is negotiable, and you're really just shooting yourself in the foot if you take the first offer. As a start, what you want to do is to get a bond originator to assist you with applying for finance. And basically what a bond originator does is that they apply to all the major banks on your behalf, right? And this is a free service, and it will save you a lot of time. If the bank is interested in financing your property, they will issue you with what's called a letter of grant. And this letter will include information such as the interest rate, the initiation fee of the loan, the monthly bank fees, And as I mentioned, everything is negotiable. Therefore, everything on this letter of grant is negotiable as well. Once you have a letter of grant from one bank, right, and they're offering you something, you are more than welcome to use that letter to persuade another bank to offer you a better interest rate. Let's just break it down quickly. What are you able to negotiate on the letter of grant? I did say everything, but let's just break it down quickly. So the amount that's been granted to you, right? So let's say you applied for 100% of the purchase price of the property and the bank only granted you 80%, right? You are able to motivate and negotiate that. The interest rate that they give you, please do negotiate that. The initiation fee on the loan, most people think you aren't able to, but you can actually also negotiate that. And the bond cancellation clause as well, right? So all of these things I mentioned are negotiable. Once you are happy with all the things that I've mentioned, then you can sign the letter of grant with the institution that you have chosen. Last thing is, make sure the property, the actual physical structure, is insured, and the home loan itself, right, is also insured in case anything happens to you. The bank will actually not grant you a loan if you don't provide proof that the property is insured. They will insist on this, so it's very, very important. So that pretty much sums up the process, or at least the key things to consider. So we talked about checking your credit score, checking affordability. We talked about location, making sure you're able to crunch the numbers on your property, approaching the bank, and things to look out for in an offer to purchase, and then finally making sure that your property is insured. Thank you so much, guys, for watching this video. If there's anything else you'd like to know about the process of purchasing a property or a home, please do ask in the comment section below. Next week, I'll be covering all the costs associated with purchasing a property. I want to say the hidden costs, but really they don't have to be hidden if you actually do your research in time. So please do like the video. We want to please the YouTube algorithm so we can reach more people and grow the channel. And yeah, stay safe, and see you next week with another video where we navigate this property investment world together.